Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 26th of August 2019 and it's a bank holiday here in the United Kingdom with sun shining, no stock markets to worry about as they're closed, and gold and silver prices rising a little, and President Trump appearing to be reducing his aggression on China. Well, at least today he is. In this video, we're going to discuss how some investment managers have differing opinions on equity markets, where they see future growth, and those areas of concern. So let's investigate. One of the most read money investment magazines in the United Kingdom is a monthly magazine entitled Money Observer. It is filled with a rich menu of subjects affecting British and overseas investors and attempts to condense their views over 2 or 3 pages. What we are going to do today is to read an interesting article by financial reporter Jim Levy, who quotes a panel of industry specialists about their view of the equity markets, which are hot and those that are not. We will name the panel in a moment and then read the article. At the end of the article, we shall highlight an alternative location the panelists believe that monies not going into equities should be placed. Yes, you've guessed it, into gold. There are 5 panelist profiles. Rob Burdett is co-head of multi-manager at BMO Global Asset Management and a research team leader. BMO has £187 billion under management. Chris Wiley is Chief Investment Officer at Connor Broadley, a financial planning and investment management firm with £400 million under management. Richard Dunbar is Deputy Head of Global Strategy at Aberdeen Standard Investments, which has some £610 billion under management. Keith Wade is Chief Economist and Strategist at Schroders. The asset management company has £400 billion under management. And Monique Wong is a multi-asset investment manager at Coutts, the private arm of Royal Bank of Scotland, which has some £17 billion of assets under management. So real gains could soon vanish down the reality rabbit hole. Markets are partying, but our panel of experts can find little reason for euphoria as global growth prospects deteriorate. Jim Levy reports. The great monetary experiment continues. In 2009, central bankers introduced us all to the weird alchemy of quantitative easing to get us out of the financial crash. To everyone's surprise, they're still at it 10 years later, even though there are growing doubts about its effectiveness, with interest rates already at rock bottom. In an effort to rekindle fatal global growth prospects, the US Federal Reserve has now slammed interest rate policy into reverse. At the beginning of the year, the market had been factoring in more rate rises. Now it expects cuts this year and maybe more in 2020. Elsewhere, heavy hints from the European Central Bank suggests more monetary easing is on the way for the Eurozone too. All this has been great for government bonds. In the United States, the UK and continental Europe, it has shoved bond prices up to record levels. UK 10-year gilts now yield less than 1%, while German and Japanese bond returns are negative. We have quite an unusual situation, Rob Burdett at BMO Global Asset Management points out. Quote, negative yields on government bonds means we lend money on the basis that we are guaranteed to get back less than we lend out, unquote. It sounds like Alice in Wonderland finance, a view held by Augustine Carstens, General Manager at the Bank of International Settlements, the world's leading financial watchdog. exceptionally low returns on bonds, non-existent in real terms, continue to encourage the search for yield and growth in global equities, as well as reigniting the attractions of gold. On the equities front, the first half of 2019 saw across-the-board gains of 10 to 20% in US, European and UK markets, as well as healthy gains in some emerging markets. Only Japan has been a relatively sluggish performer. Quote, "With interest rate cuts pending, it no longer seems plausible to expect a recession in the US within the next 12 months, unquote, says Connor Broadley's Chris Wiley. That is the basic building block of this rally, he says. But Wiley wonders whether the building block is made of stone or sand. Quote, "You have to believe the rate cuts will be effective, but the markets, bears, have been arguing that monetary policy has now lost its power because we have had low interest rates for so long," unquote. He is far from being alone in his cynicism. The June Global Fund Manager Survey from Bank of America, which covers about 180 fund managers with around $600 billion in their tender care, was the most bearish since the financial crisis. It showed cash levels rising and the relative allocation of equities over bonds at its lowest for 10 years. That, paradoxically, is positive for Coutts Monique Wong. Quote, "It clearly shows investors are certainly not in euphoric mood, so I don't want to get too negative," unquote, she says. Euphoria is not something we have come to associate with Richard Dunbar at Aberdeen Standard Investments. He rarely takes his equity sector scores above 6. Quote, "I'm not changing our scores much," he says. "The past few months have taught us to be fully invested, but with reasonably balanced portfolios, and this makes more sense than betting the farm on any one idea," unquote. Dunbar admits that government bonds hardly represent great value at present, but he insists, quote, "They do have a place in a portfolio. The lesson of the past few months has been to be exposed in both bonds and equities," unquote. Schroders Keith Wade also joins that cautious consensus. Quote, "We expect an imminent rate cut from the United States Federal Reserve and another one in September, but our experience is that it takes much longer for those interest rate cuts to percolate through," unquote. Burdett stresses how difficult it has become to judge prospects during this period of monetary experiment. Quote, "The fund managers survey from Bank of America shows everyone is more gloomy, but markets are still going up. We live in unusual times, and a lack of wage pressure is still a feature in key economies such as those in the United States, the UK, Germany, and Japan," unquote. He believes equities remain relatively attractive, but there may be much more volatility in markets in coming months. Quote, "While interest rates are now expected to be lower for longer, we think dividend expectations are for further continued growth both this year and next," unquote, he says. Dunbar agrees. Quote, "There remains a powerful attraction in the return offered on equities in this very low interest rate environment," unquote. As usual, US equities remain the key debating point among panel members. There are no changes in scores this time round, with numbers reflecting a cautious mood. Indeed, panel average scores for all equity sectors range narrowly between 4.8 and 5.8 since the previous review in the May 2019 issue of Money Observer. Even though Wiley's US score is only 4, he acknowledges that, at least in the US, I have growth despite valuations looking toppy. I have to find growth because returns offered by bonds and cash are so low. However, he remains nervous about prospects. He says, quote, "There is a fin de siècle feel about the world right now, a feeling that we're trying to squeeze the last drops of juice from the growth lemon. Our growth indicators for the US have rolled over in recent weeks," unquote. Burdett argues that one of the attractions of the US market is, quote, a unity of political opinion, even among Democrats, about most aspects of the capitalist system. It's not the case in other parts of the world, and it underpins the US market, unquote. That's why he's keeping his score at 4 while sticking with a score of 9 for cash. Quote, we're not expecting an economic calamity, and if there is a correction in equities, we will probably be buying, unquote. Wade scores a 6 for the US, but he fears the US economy will grow at barely 1.5% next year as the effects of Donald Trump's past tax cuts fade. He is one of those who doubts the effectiveness of interest rate cuts. Quote, it is difficult to see how global growth is going to come from monetary stimulus. It will have to come from fiscal expansion, unquote, he says. Dunbar keeps his score for the US at 6, but he is looking to take some profits soon. He stresses the importance of the settling of the US-China trade dispute. He thinks any revival in global growth will have to be Chinese-led. However, he says, quote, recent moves in China to stimulate growth have not had as much impact as some had hoped, unquote. UK equities remain as shrouded as ever in the uncertainty created by the Brexit disruption. A feeling that almost anything could happen has prompted both Wade and Burdett to take profits and lower their scores. Wong has not lost faith yet. Her score of 8 for UK equities is like a beacon of light amid the Stygian gloom. Quote, I like UK equities because Brexit produced the opportunity to buy, but silly me, I thought Brexit would be settled by the end of March. Now I fear it will become even more protracted, unquote. She feels that uncertainty also creates opportunities for those prepared to buy the UK for the longer term. She has support from Wiley, who says, quote, we are more positive on the UK than we've been for a while, unquote. But he sticks with a score of 6, but points out that if Brexit is bad in the market's eyes, the pound will reflect that. He adds, quote, if it's not so bad, there is ample room for a market re-rating, unquote. Keith Wade has cut his score from 6 to 4. Quote, the risk of a hard Brexit or general election and a more left-wing government has increased, unquote, he says. UK equities remain out of favour with foreign investors, as much because of sterling's weakness as anything. The average panel score for the UK is now down from 6.4 to 5.6. Some emerging markets have fared well so far this year, and there are hopes that a weaker dollar, prompted by lower US interest rates, might boost the performance of this part of the world further. The only score change has come from Rob Burdett, down from 8 to 7. Quote, we think there will be more volatility in equities in the coming weeks, and that usually means a stronger dollar as investors seek safer havens, unquote, he says. European equities have performed well this year, with average gains around 15% in the first 6 months. Yet the panel remains unenthusiastic. Only Burdett has raised his score from 4 to 5, while Wiley has taken some profits. There were no changes in the scores for Japan. The country underperformed other leading equity markets in the first half of 2019. Burdett is still the most bullish on Japan. Quote, it remains fundamentally cheap, unquote, he says. Dunbar fully supports his view. Elsewhere, Wong is taking some profits in government bonds, and Burdett has trimmed his score for UK bonds. But Wade has raised his global bond score from 5 to 6 because his fear of recession has not entirely gone away. Quote, Schroders is quite cautious about the global growth outlook. We think financial markets will need a few rate cuts before they are convinced about a revival, unquote. Meanwhile, his cautious stance includes emphasis on large companies offering basic products and services. He adds, quote, we like companies that make things you have to buy even though you think the world is coming to an end, unquote. Perhaps recession is what the markets now need, as the US-led bull market in equities is now 10 years old. Warren Buffett, the legendary Berkshire Hathaway investor, admitted recently he had a mixed view on that prospect. Quote, "I have seen many recessions, and I hope to see another one," unquote. Wong points to the attractions of a recession for investors. She says, quote, "A lot of investors fear a recession because the last one was the global financial crisis, but I don't believe there are enough imbalances in the system to warrant a recession of that magnitude next time," unquote. She then adds, quote, "Recessions can be healthy. They reset the cycle, they reset the game, and they reset valuations," unquote. That's presumably is why wise old Warren Buffett likes them. End of article. Well, that was an interesting divergence of views on equities, but the panelist members do not stop there. This is what they say about one of our favourite precious metals, gold. We'll quote them directly. "One notable effect of the complete change of tack on interest rates has been a revival of interest in gold. Wiley says his portfolios now have just under 10% exposure to gold on average. He believes it is negative real interest rates on government bonds that have been driving the gold price to new highs, rather than trade wars or fears of war in the Middle East. Coupled with this, there are signs that the recent downtrend in the price of oil may have come to an end and be about to turn upwards again. There's been very little capital spending on the search for new resources lately, and I can foresee a possible supply crunch for oil within the next 3 years, Wiley says. Richard Dunbar agrees. The oil price has fallen by nearly 20% this year, and pressure on the price is now on the upside. Together, these influences have prompted 3 of the panel to raise their scores for the commodities sector, driven by these 2 key components of the commodities mix. The average score is now up from 5 to 5.8. This is the only average score to have risen in the latest survey. Monique Wong says, quote, "When real yields fall, you can expect the price of gold to rise. And of course, to non-dollar investors, gold has become more attractive because it is priced in dollars," unquote. Gold has also become a significant part of the more defensive investment strategy mix at Schroders. Wade says, quote, "We have taken some profits on our government bond positions and increased our exposure to gold," unquote. Monique Wong points out that one reason for the recent strength of the Russian stock market, which has risen by 30% this year, is the benefits Russian oil companies get from oil being priced in dollars. Quote, "Their cost base is in rubles, and their revenues are in dollars," unquote, she says. So there we have it. A general consensus that whilst equity markets can rise further, they are nearing their peak. Oil could be subject to a squeeze, though our view differs from this slightly in that we foresee major gluts ahead. Bonds yielding negative rates will now only be of interest to the largest of institutional investors, and that interest is waning as gold now becomes more interesting to them as an alternative to bonds. This is one reason why we believe that the gold to silver ratio, whereas in the past has corrected significantly when exceeding 80 to 1, may not do so for some time yet, as institutions start or continue investing in gold. Too few invest in the silver market for it to be of interest, and one day it will catch up. But for now, we shall be looking for bond monies gravitating towards gold once equities fall out of favour. What do you think? Do share your views. Finally, this evening at 11 p.m. British Standard Time, we shall be having our draw for our 100 plus members on our Discord channel. So you have literally a couple hours to sign up for Discord if you are not already a member. And then at 11 p.m. British Standard Time, To log on to Discord, you have to be logged on when the draw takes place. One lucky person who has signed in, and they could be as few as 10 of you or as many as 110, will receive the equivalent to the dollar price of 1 ounce of silver at the time the draw is taken. So as we said in a previous video of Bix Weir fans, if it suddenly rises to $100,000, you're in for a fortune. But more than likely, $17.50 or close to it will be the prize. Thank you for listening. We look forward to seeing you on Discord this evening.
We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.